Today's discussion is really legal and compliance focused, but not just what we shouldn't do, but what we are doing and plan to do over the next year. What we're going to cover today, we're going to go through a little bit of where we've been historically with Molecule as it stands. What's changed a little bit, particularly in the United States over the last year. I think everybody's aware the basic level of what's happened, but going to get into a little more detail on how that applies to what we're doing within the DeSci movement. I'm going to go through something that we've been developing called the coin-to-company model, what that is and what that means for the ecosystem, how it works, particularly with a token locking and equity system, what's different about it, and then what are the benefits of it, what it ultimately produces. So Molecule historically has been set up in Switzerland, organizing DAOs through Swiss vereins or associations, using the Swiss DLT Act, a combination of laws in Switzerland that allow Molecule to legally launch tokens. As you know, Europe and Switzerland were well ahead of the United States when it comes to passing crypto laws and making this available, and Molecule took advantage of it. It created, obviously, the IP-NFTs, one of the first primitives that everybody here is aware of on ERC 721 tokens, and what we call IPTs, which under Swiss law are technically governance tokens. And governance tokens means that the project provides the ability for people to give input into the direction of the research, and they also have the token as an asset. However, the tokens are not securities. And what does it mean to not be a security? It means that they don't have an inherent legally enforceable economic right in the proceeds of the business. And that's really the critical challenge within crypto historically. It's what people have often tried to overcome in structuring crypto projects and initiatives. However, as everyone knows, with the change in administration in the United States, it changed the U.S.'s posture toward the crypto industry. In fact, the current administration said that they want the United States to be the crypto capital of the world. And so we went from a posture of the United States government pretty much suing everybody and anybody they could to saying, please come in and build your crypto business here. And with that, Molecule looked at that and said, the United States is one of the largest opportunities for biotech in the world. And so Molecule, of course, looked to take advantage of that. And over the last year, we've been not only looking to enter the United States with the current setup that we have in Switzerland, but seeing how can we go beyond? And how can we create biotech projects that are both based on the blockchain, but also provide people with compliant ways to get the proceeds of the work being done. And so this year, we actually met with the US SEC and told them what we're doing and discussed our plans for them. Had an open dialogue. It's with the entire crypto task force, including Hester Pierce, as many of you may know, the leader of the task force, who's a personal hero of mine, by the way. And it was a great conversation, and I think that they're very supportive of what we're doing here. The SEC itself released its own taxonomy for tokens, and we have analyzed what we're doing within that taxonomy and feel quite comfortable how we fit within that as a digital commodity or a digital tool with the IPTs that are being released in Switzerland if they are purchased by US people. And then, as people might be aware, that there's new legislation in the U.S. being considered called the DLT Act that had a major movement earlier this year when it was passed out of the Senate Banking Committee, and it's being considered by the full Senate here, either in July or August. Still trying to figure out the final date for that vote. But there's a very pitched battle at this moment between traditional banking companies in the United States and crypto companies as to the details of the DLT Act, but it's moving its way forward. So that's where we things stand and how things have been progressing in the United States. What we've been working on, though, over the past year is an entirely new model that, quite frankly, has never been done before. And it's really an attempt to take the best parts of what Molecule has done in the past with DAOs and associations and community groups and integrate them with traditional venture-backed startups because they both have their own virtues. People recognize the power of the community. We're all sitting here in this room, for example, because of that. However, there's a lot of virtues to traditional venture-backed equity structures because it allows you to interface with non-crypto institutions, traditional venture capitalists, who expect certain legal structures and certain rights in order to invest their money. And we all know that this industry takes a lot of capital, quite frankly, far beyond what we can raise in just tokens. And so we need to find a way forward where we can take the best of both and put them together. Quite intentionally, I've tried not to innovate in many respects with this model and reduce the surface area of what needs to be thought through in order for it to be effective. And so what CRIT is, it's a two-entity structure. The way crypto is normally set up, at least in the United States, is that you have a Delaware, what they call a DevCo or LabsCo, and then the tokens or the blockchain is held in a Cayman Foundation. And the two are, for legal purposes, treated as entirely separate. And that actually has worked, even during the Gensler area pretty well. However, for those who are familiar with certain controversies in the crypto community, like with Aave, it creates a lot of tension between the token holders and the shareholders of the DevCo as to where value is accruing, how value might be going back to token holders, if all. And it's one of the biggest issues to overcome to move these businesses forward. And so we have a similar setup, again, taking the best of both. However, asking how can we integrate DAOs with DevCos? Is there something that works that does not turn the tokens into securities? Because if the tokens were considered securities, I think most are probably familiar with some of the issues, but some of the biggest problems with that is it brings in certain requirements as to who can purchase them, the registration reporting with the government, and a lot of liability issues in regards to that. And that's why people try to avoid that status and work so hard to do that. And in this model, we work very hard to keep the tokens as non-securities, as pure digital commodities that can trade freely, just like they currently are. However, what we have worked to do is create a way for those token holders to become shareholders, which becomes an enormous unlock for letting them get value in the project itself. So to go from a token holder to shareholder, what is that process at a high level? We launch a token just like we do today. Nothing changes in that respect at all. It can be done from Switzerland in the normal verein structure that we do today. It can be done from the US. It can be done from the Cayman Islands. The tokens are digital commodities like wheat or cattle. They can be traded anywhere. They're just a product, basically. However, the company, the DevCo, which is a Delaware company because, again, it's the default for investment purposes and is very non-controversial, makes available to token holders a program, an equity program, where token holders can come and lock their tokens to the company, stake it. And the staking process is very similar to how it works currently, for example, with bio, where you vote escrow your tokens. It's a very similar technological mechanism. And so when you lock your tokens to the company and vote escrow them, there's an equity program. And then the equity program follows a compliant pathway in the United States, well-established, non-controversial. If you are an investor in a company, that's what we call Regulation D in the United States, or if you're a worker, it's called Rule 701. The Reg D pathway is well known. That's how traditional investors invest in companies, and we follow all the same compliance processes that you would do for that pathway. Rule 701 is how any employee of a startup gets equity in an unregistered restricted stock. So, Molecule, for example, has an equity program. I mean, it's a Swiss company, so it doesn't follow Rule 701, but if it was a US company, it's the same thing. And these programs are similar around the world. What's a little bit different here is we want to make it available to the community. One of the best parts about crypto, it's egalitarian in nature. It allows really anybody to participate, and we really wanted to keep that aspect of this program. And so what we are doing, which is a little different, is we are making equity available to community token holders through Rule 701 as contractors. They participate in the projects. They, as I say, yap on social media. They give input into projects. And so for all the stuff that they're currently doing, we'll allow them to sign an agreement with the DevCo or the LabsCo and get stock. What's really important here, though, is to understand that the tokens are not equity and the equity are not tokens. What is innovative here, which sounds surprisingly simple but has not yet been done, is that the equity lays on top of the tokens, but the two are not the same thing. The tokens eventually become identity tokens or instruction tokens that tell the company what to do. So if someone had tokens, locked them, became a shareholder, they would use the tokens to identify themselves per share to the company, but also instruct the company what to do with their equity. So if a resolution came up from the company and they wanted shareholder votes, the company requires that people use their tokens in order to vote. If the company were to be purchased and distributions to be made, distributions again would go through the blockchain. And what this does is it sets up the company to be a crypto-based company, but have all the benefits of operating like a venture-backed business that everybody knows. And so it becomes a hybrid two-asset model where you have both the tokens functioning as a digital commodity, but you also have the equity as well, working together in harmony in a way. And this works under current US law. Quite frankly, you don't need any change to implement this. It uses existing pathways. It also works under clarity. So if clarity were passed, we've done analysis as to how this would fit underneath that. The tokens would be considered what are called ancillary assets under that legislation. A little bit of an awkward term, but that's what the statute uses, and that's what you'll start hearing people say if it does pass. And if they're ancillary assets, they would be sold under an investment contract, but the tokens would be treated as digital commodities all the same after that point. And so it actually complements clarity in that respect. Because what clarity does do, it creates what's called Reg crypto. It creates a statute that allows crypto fundraising. But what it doesn't do, it doesn't solve the problem that still exists, which is how do token holders get value in the project? It actually doesn't solve that question at all. And so this process here is really trying to change that. Because in crypto, you don't necessarily need an answer for that if it's a novel L1 blockchain, where people are getting emissions from the blockchain, staking with the blockchain. Where it is a problem is if you're launching a crypto token and actively developed IP, much like we have in our community. That's where securities laws come in, the Howey test, as you probably heard. So the final result, though, is trying to put the companies into a posture to benefit from the increasing tokenization of assets. And so once they are operating a blockchain, use the tokens to administer their equity, the company can also, of course, leverage everything that Molecule's built to date. So the tokenization of IP and IP-NFTs, tokenizing royalties from signed royalty agreements and be able to distribute those on-chain, tokenization of contingent value rights in IP, and then tokenization of the securities themselves. And we have not, by design, tokenized the securities themselves in this right now, but it's certainly in our mind to do so in the future. There's some tweaks that need to occur still in US law to make that work that are currently in progress in the United States. And when that happens, we expect to eventually tokenize the securities themselves in the project. I think one final detail is something else we've really worked hard to build into this design is the ability to interface with traditional universities, institutions, VCs that have nothing to do with crypto. In fact, might not even want to touch it or deal with it. Because I think for us to succeed, we need to interface with the larger world. bring the benefits of the blockchain to them, but not force them to use it if they don't want to. And so if you using this model and want to partner, for example, with an investor that doesn't deal with crypto, they can just buy equity in the company. They're required to have the tokens to exercise, but the company can do all that on their behalf. They don't have to touch it at all. So for example, if they wanted to vote, just like a normal startup company that isn't crypto, they would tell the company how to vote, and the company would simply exercise that vote on-chain for them under what's called a proxy agreement. And again, if they want distributions, the company can convert the on-chain distribution to fiat and simply send them to fiat. And so this allows the company to integrate with both the crypto ecosystem and the non-crypto ecosystem at the same time, which is something we really work to try and build into it. And really just trying to close the loop. Launch the way we do today, but provide a pathway toward building real value in companies and distributing that value out to the people who have supported the company all along. And so just going over the overall compliance architecture in this, the different aspects of it, you have the initial project tokens. These are essentially the IPTs, but we're just calling them project tokens now in this US model, which are the digital tools or ancillary assets under Clarity. You have your locked receipt tokens. Once you stake your project tokens, you'll get a locked receipt token. That's what you use to exercise or instruct your equity. You have your investor equity itself sitting on top of the tokens, most likely under Reg D, but there's other pathways to do so. Contributor equity, so that's under Rule 701, where you're giving your work or labor in exchange for equity. And then Clarity Act tokens, which again are the project tokens, but would be structured under the Clarity Act. And those are the legal primitives within the structure in its design. So, really the vision realized here is creating a global community layer, IPO profit and IP success, and having it be defensible, and allowing you to go to traditional companies proudly and say, this is our structure and this is how it works. And everybody having confidence in it. And so that's a C2C model.